You're always fundraising, which means you're always selling a certain percentage of your company. It's a question of, is now the right time to sell 100% or not? When those windows open up for exits, usually it opens up for tech and health and other things first, and climate usually trails.
What's the biggest myth about exits in deep tech?
They don't exist.
Hello and welcome to VCO2, the podcast that helps you become a smarter impact investor and a better climate tech entrepreneur. Today, we are joined by Matt Jones, managing partner at Syensqo Ventures, to explore the key considerations for deep tech exits and how corporate partnerships can drive success. If you like this episode and if you like the show, don't forget to like, comment, and subscribe on YouTube, or give us a 5-star review on Apple Podcast and Spotify. Let's dive in. And I guess to kick things off, can you tell me about the exit strategies that startups have once they reach that stage?
Well, and we're specifically talking about climate tech startups. So let's put it into that context. And whether you're raising a seed round, an A round, or going for an ultimate exit, it's just a different stage for the startup. And so exit is really more of an investor construct, if you will. Different investors want to get in and have a financial return at a certain point, but the company is going to continue. So I think about it less as an exit, because I think about it from the entrepreneur standpoint, the company standpoint. It's about different stages of the development and different stages of investors who are going to continue to back the company.
Okay, so just to continue on that, so obviously for startups and companies that will continue to grow after the exit from investors. But if I'm a startup and I'm thinking about, or if I'm an investor, actually, I'm thinking about exiting a company, what are the options on the table?
I mean, the options are all the above. I mean, whenever an investor gets in, they want to have that big return potential. So you try and look at, are there analogies to being a public company? Is the story big enough? Are the economics good enough that you could see a pathway with the team as well to actually have that potential? But as in all things with, startups, M&A, that really is the bread and butter for where these things are going to go. And that can be a complete company acquisition. It can be an asset acquisition. It can be the founder reacquiring the company at some point if it doesn't meet those hurdles of being a venture deal. And there's differences within that. You can have private equity firms who step in and provide an exit. But again, it's a different stage. It's just how the company is being financed at that point in time. And I think about it in terms of, the investors, we can take certain risks and we can help the companies grow at certain points in their journey. And so there are logical places where it makes sense to recycle your cap table, take out earlier stage investors and add in different skill sets, different checkbook sizes, different time horizons to help support that company on its journey.
Yeah, and ultimately it benefits the ecosystem, because if the earlier stage investor exits, then they have more money to put back into the ecosystem, which is a great thing. Are we actually good at making exits in climate?
I think we are. The challenge is when those windows open up for exits, usually it opens up for tech and health and other things first, and climate usually trails. And so the window is shorter for climate tech opportunities. It usually comes on the back end of a growth phase. And so once that window closes, as we're in a closed window right now for exits, it closes. So I think the window is shorter for climate tech companies. But over my 25 years of doing investment in hard tech and climate tech, I'm seeing a lot more appetite, a lot more understanding, and a lot more appreciation for, the problems that climate tech is solving for customers. This is not solving it for the climate. It's really solving it for customers. That there's more and more awareness and more people who understand and have capital to put behind those opportunities.
And that's definitely a great thing for customers and for the planet as well. But going back to what you said on the window, a lot of people mention that window opening and closing. How do you know when the window is open and when the window is closed, right?
Well, again, that's why if you're an entrepreneur, you want to have investors who've been through those cycles before. The reason why you have investors, you have a board, is to help you think about those things. You may be heads down running the company. You need other people who can say, look, I've seen this before. And there's always windows. You're always fundraising, which means you're always selling a certain percentage of your company. It's a question of, is now the right time to sell 100% or not? So those windows, I think it's timing, luck, and having good advisors who can help you think about your various options.
Yeah, that makes a lot of sense. Going on the different options that you have, I'm curious. It feels like the IPO is a golden exit, right? Like it feels like it's a dream for every investor. How do you know if a startup is ready for IPO? What are the key signals?
I mean, it's really responding to the market and what the market is, what those customers are buying, what those investors, institutional investors, are comfortable with. And right now, they're not in a comfortable mode with high growth companies as we've seen in the stock market. So it is really looking at what the customers, what those investors are looking for. So the hurdle is based on what the market is telling the startups. So right now, you have to be EBITDA positive, you have to be growing. Even for acquisitions right now, you have to be accretive to things. And so startups, the exit opportunities are really challenging, but there still is funding opportunities. So now is not a good window for 100% exit. Now is a good window to continue to go down a capital structure path of raising capital.
Have you done some exits yourself, like some IPOs actually?
Well, yeah. So I've now been at Syensqo for 8 years. It's a global corporate. So I head up our corporate CVC. And in that time, we've invested in 20 different companies and five different funds. And in that, we've had one company go public through a SPAC mechanism back in 2021. And that company is still doing fine and doing well. Um, and we've had two M&A transactions, and we've had one where, it didn't work out, and we've had to wind it down with the entrepreneur. So the answer is yes, all the above. Over that period of time, that's what it takes for climate tech investors to succeed.
And I'll go a little bit sideways, but is it a strategy for CVC to take company public?
It is. Well, again, in our form of venture capital or corporate venture capital, we're looking to develop our suppliers of the future or customers of the future. Our thesis is not to be the acquirer of the startup. When I make an equity investment, I want to be on the same side of the table as the entrepreneurs. And so therefore, I want them to be successful because if they're a supplier to us, I want a quality supplier. If they're customers of ours, I want them growing really fast and buying a lot of our materials. So, you know, within corporate venture capital, there's different ways of there are different theses. And so entrepreneurs should know what the thesis of all their investors are, be it corporate or financial or impact. What do those investors want to get besides a financial return? So I'm 100% around financial return, but I also think that's augmented by the fact that as a strategic, again, I can either be a customer or a vendor too, and that helps me understand the opportunity that much better.
Yeah, for sure. And I think for a startup on which you want to become a customer, I think it's has double impact for the startup. It's really beneficial for them because they not only get an investor but a customer as well at the same time, which is quite a good thing for startups. If we switch gears a little bit and talk about acquisition, if I'm an entrepreneur, how should I think about who can acquire me, like about potential acquirers?
It's a great question. And I think you have to write the investment thesis for the acquirer. You have to come for them with the story of why it's important for them, why they can help grow and see a longer term. So, just as you would go raise a Series A round and you have to do your diligence on the different funds that you're raising from and how you fit with them and why you're a good investment for them, the same exact advice for any startup going for an M&A process. Um, I don't like to involve banks a lot of times because it is a personal sale. It is about the vision. It is about, where the technology can take a company. Rarely is it just about the bottom line, EBITDA, can it be accretive? If that's the M&A, it's not going to be an exciting M&A. That M&A has to be around the corporate seeing the potential, seeing that vision that got the entrepreneurs to start the company in the first place, investors to put money behind it. So you have to sell that emotion and then justify it on the spreadsheet.
And how do you make sure that it's a successful M&A and that the product or the company continues to succeed after the M&A?
That's challenging because a lot of times as venture firms, again, this is what I talked about at the beginning about stages. The entrepreneur, the management team, they're going to continue with the business, or hopefully they're continuing with the business. So that ability to control and make sure that it's still an ongoing business then is out of the hands of the investors to that point. So again, I think that is that alignment. And if you're thinking about an M&A path as an entrepreneur, as a board, you should ask that question when you're thinking about who are the targets. And just like investors diligence entrepreneurs, I think those entrepreneurs and the companies, when doing an M&A, should diligence the corporate. How have they done it with other startups that have been acquired? So, again, I think that's where you can't ensure. I mean, things are going to change. A startup has a vision, they have a thesis, and they're going to move really hard and try and make those milestones. Even a corporate buying a startup, they're going to have a thesis and try and, they don't control the macro environment a lot of times. They don't control the technology sometimes. So people are going to go into it with the best intentions, but things do change. So long answer to say, I don't think you can control it because life happens.
For sure. And I would extend what you said on the diligence to also earlier stage. I think it's very important for entrepreneurs to make sure that they have the right investors on the cap table. I mean, you have smart money and you have money as it is, right? And I guess it's very important for entrepreneurs to find the right investors. Going on to the role of corporates in shaping the startup exit strategy, how can you help? I'm an entrepreneur, I have a corporate on my cap table. How can I request some help from them to make sure that the exit is successful for them and for other investors?
Yeah, so that's one where, I'm not focused on Syensqo necessarily being the acquirer. As I said, things happen and maybe it changes. But again, I think at the end of the day, it goes back to what is that alignment? So my company, Syensqo, we sell high performance materials. So it's small volume, but super high value, high customer touch. So if you're a startup trying to sell to my company, you would have to fit with that same business model. So a lot of it has to do with the fit of the culture and business model of that company. If you want to sell millions of tons of commodity chemicals, again, I'm not going to be able to help you. That's not going to be one where I'm going to be able to say, here's how you craft your business model, because that would be asking the corporate to do something, not only take a risk on the startup, but take a risk on a new business model. And I think, a lot of times investors will talk about focus at a startup, focus on what you do really well and try and minimize risk. And so in that M&A process, if you're asking a corporate to take the risk on maybe an earlier stage company that they normally would acquire and a business model risk and team risk, it makes it harder. So I think it is finding those candidates and building those relationships ahead of time. Not to build your business, solely for an M&A to a specific corporate. That'd be too prescriptive. But knowing that there are different options and how you know, build the company over time. Your business model as a startup is somewhat flexible. What do you sell to whom and what do they pay for it? That can evolve over time. And as that evolves, that's going to change who's going to be interested in acquiring you.
Makes a lot of sense. And do you like to see as an investor yourself when a company comes to you with already kind of a plan or like potential acquirers for the future? Like, is that something you like to see?
Yeah, I'm more old school where I like people to have thought it out. I like people to have a North Star. I think you can have a North Star on the product and the customer value proposition. I think also having that North Star on when I grow up, I would be like company X, I think a lot in analogies. So I think having thought that through. Now it is going to be dynamic. It is going to be fluid. But I think if you don't have a thought in mind of the ending place, the journey is going to be very disjointed. So I like people who have an idea of the destination, and that destination can change over time. I mean, that's what startups are great at, is taking in information, getting information fast, pivoting, changing, augmenting, whatever you want to call it. So yes, I do like companies to come in because I think they have to have that North Star. But as an investor, I'm also, understanding that things change. And so let's take data. Let's take, what we're hearing from customers and figure out within our business model what needs to change.
Yeah, because it's funny on that question. I've asked it to a lot of investors. Some of them hate it completely. They want startups just to focus solely on the business, and some love it actually. So it's kind of a black and white situation. I don't know why. But going to
It goes to knowing your investor. Hey, certain investors are going to want to hear it, certain aren't. So if you can do your networking and find out, you got to sell to the customer that's in front of you.
yeah, unfortunately, there's not a list of investors whether or not they like to have an exit strategy. Well, I guess one last question before we jump to the next section. What are some of the common mistakes you see when startups engage with Syensqo? So startups that are trying to raise money with you, is there something that they should do specifically because you're a corporate VC as opposed to traditional VC?
Well, whether you're a corporate VC or traditional VC, I think entrepreneurs, the great entrepreneurs know why they're coming to a fund. So I want an entrepreneur who comes to Syensqo and says, "Hey, Matt, your company is great at X. For example, we do composites. Um, you're great at composites. I have a new concept for a UAV or some sort of vertical takeoff and landing technology. I want you to help me on that part. I want your company, your knowledge on how to build composite parts." That's a great way for an entrepreneur to approach me because it fits with my thesis. They want to go develop a new market. They're going to need materials to do that. I can help assess and understand from a venture perspective, are they a credible company? Can they raise capital? What do their other co-investors look like? I can help my company make the decision on, from an opportunity cost perspective, how and how much should we work with that startup? A startup who approaches me saying, "Hey, Matt, I heard you on a podcast. You're in the venture capital world. You do climate tech. We're looking for money." And I ask, "Well, what do you know about Syensqo? If I could set up a call internally with an expert, who would you want to have that call with?" The entrepreneur that says, I don't really know, that to me means that they haven't done their homework and they're just looking for money. And that's fine. But at the end of the day, I think a lot of investors think about we bring more than just money. And so understanding that as an entrepreneur and being able to articulate it is really important.
Yeah, and that's a great piece of advice for someone listening to this podcast. Do a bit of your research before reaching out to Matt. But I guess we have one last section today. This section is called the fire questions. You'll have one sentence maximum to answer each question. Are you ready for that?
I'm ready.
What's the biggest myth about exits in deep tech?
They don't exist.
If you could change one thing about how corporates engage with startups, what would it be?
They have to speed up their processes.
That makes it. Is the processes slow at Syensqo? Is it slow on your side, do you think?
I'd like it to be faster. We'll put it that way.
What's a red flag that founders should watch out in corporate partnerships?
Not all partnerships are going to work out. So I think they shouldn't put all their eggs in one basket. We're just like a startup. We're going to have a thesis and we're going to go test it. It may or may not work. So corporates act just like startups as well.
What's one piece of advice for a founder who is currently navigating an exit?
Build personal relationships and do it yourself.
What's a green flag when investing in a startup?
Great team.
And what's a red flag?
Team who hasn't done their homework.
So it's all about the team?
It is. I mean, that's who you're investing in. It's the old adage of venture. So yeah.
If you were not a VC, which role would you play in the transition?
I would work, at Syensqo, I'd work at how we transition ourselves. So I'd be that internal champion for how to transition to, green electrons, green thermal. That would be my role.
What are the three most important things to be a successful impact VC?
I think you have to have conviction. I think you have to have science and knowledge and not just hope. And you have to have a strong network.
What's one piece of advice for a founder entering the climate tech space today?
Do it.
I love that. All right. Well, a couple of last questions. What's one resource, a book, a movie, a podcast that you would recommend people to listen to learn more about exits?
More about exits.
Or more about investment in general?
More about investments. I always like Eric Ries and the Lean Startup. I think even though it's maybe targeted more towards, software startups, I think there's a lot of great lessons. Always talk to your customer, iterate fast. It's harder in hard tech, but equally important.
Well, I guess the question I should have prepared you for, but who's the next climate VCs that I should interview, and maybe someone that's at Ella tomorrow as well?
Well, Breakthrough Energy Ventures is here. And what I like about them is they're bringing not just capital to the table, but they're bringing thoughts on policy and finance. So in terms of a group that's doing a little bit of everything, I think they're doing amazing things.
Lovely. And if people want to reach out, if you do your homework before, but where can they find you online?
They can find me at Syensqo, our corporate website. We have an innovation page, which has details and contact information for the venture group. They can also find me on LinkedIn at Matt Jones at Syensqo. And Syensqo is SYSENQO. So it is like a startup. It's a unique name. And
super. Well, thank you so much, Matt, for today. Listeners, if you like this episode and if you like the show, don't forget to like, comment, and subscribe on YouTube, or give us a 5-star review on Apple Podcasts and Spotify. Thank you so much, Matt.
Yeah, thank you so much. Appreciate it.